talk about the CAPA model or the capital asset pricing model. So now this capital asset pricing model is simply used to calculate the cost of equity. It tries to establish an equilibrium relationship between the cost of equity and the systematic risk, that is beta. I'll make you understand in a nutshell. So basically, the CAPA model is trying to establish an equilibrium relationship between the cost of equity and the systematic risk, which is denoted by beta. Now, your CAPA model is ultimately used to calculate the cost of equity. So as the formula states, the cost of equity, which is being represented by KE. So KE is used to represent the cost of equity in the financial terminology, is equal to RF. RF stands for the risk-free rate plus beta, which is the measure of systematic risk. So RF stands for the risk-free rate. B stands for beta into the difference of the return on market minus the risk-free rate. So this difference that you see, the RM minus RF, it is technically called as the equity risk premium. It is technically called as the equity risk premium. And now we'll try to understand these in nutshell. So what exactly do we mean by the cost of equity? So the cost of equity is simply telling you the expected return that you might make upon your equity investment. So for example, if I invest 100 rupees in the stock market and I expect that I shall be making at least 10% out of it. So 10% becomes my cost of equity. That is not my actual return upon equity. My actual return might be ROE, the return on equity, or the return upon capital employed. So actual return is different from the expected return. Cost of equity simply gives me the expected return upon my equity investment and not the actual return. The formula simply states the risk-free rate is equal to the risk-free rate. The risk-free rate is simply the rate or the interest rate or the yield which you get if you invest into a safer security bond, a government bill, a treasury bond, a treasury bill per se. Because those assets or those fixed income securities are expected not to default because these are backed up by the government of that specific country. Again, that we need to understand. Default risk might be next to negligible. So some countries still tend to default, and the rating of those countries is also low. So usually, upon a government security, you shall be getting a lesser yield as compared to the return upon equity. The basic principle of finance: higher the risk, higher is the expected return. Since you are investing into a government safer fixed income security, almost negligible default risk-free security, the return that you shall be making might be less because you are taking lesser risk. Higher the risk, higher is the expected return, and vice versa. But again, these kind of securities also tend to possess certain kind of risk. There can be interest rate risk, there can be some reinvestment risk, there can be some duration risk. But broadly, in terms of the credit risk or the default risk, these securities are absolutely free. Now, the second parameter that you have in here is the beta. So beta is the proxy for the systematic risk. Beta is the proxy for the systematic risk. Now, basically, there are two types of risk in the market. One is the systematic risk. The other is the unsystematic risk. Now, the unsystematic risk is something that we can diversify. It is also called as diversifiable risk. So, for example, when we create a portfolio, having multiple stocks from different sectors or themes, we tend to diversify the non-systematic risk or diversifiable risk. I'll give you a simple example. So, for example, if I just invest into the IT companies, into the IT stocks, and we have seen in the previous quarter or the previous past by months the downfall of the specific IT companies in India. So if I had just invested into the Indian IT companies or specifically just the IT companies, my portfolio would have been negative because these stocks have corrected by more than 30-40% odd. But if I would have added some PSU banks, some metals, some healthcare, some energy companies, my portfolio would have been safer and still yielding me a positive alpha or a positive return. In that scenario, I've tried to diversify my risk, and that's my unsystematic risk, which I can diversify by creating a portfolio. Simple to understand. The second risk is the systematic risk, which I cannot diversify away even by creating a portfolio. The systematic risk is also called as your market risk, जिसको आप diversify कर ही नहीं सकते. It can be some geopolitical tensions, it can be some war-like scenarios, it can be some kind of a war, it can be some recession, depression, it can be some tsunami, some flood, which will impact the total economy in general. In that scenario, even the strong performing stocks or the stocks or the companies which are fundamentally very strong will also correct or even crash, because that factor is creating an impact upon the whole economy. That's the systematic risk or the market risk. Now, here beta is the proxy for only the systematic risk or the non-diversifiable risk, the risk which you cannot diversify. So here we have beta into the equity risk premium. The RM minus RF, the difference between the return upon market. The return on market is simply your Nifty 50 ka return or index return. It is not a stock specific return. So broadly, a Nifty 50 is expected to give you a much higher return versus the risk-free rate. Because when you are entering into the equity markets, you are taking a certain amount of risk. So for that risk, you are eligible or liable or expected to make a higher return. So the difference between the excess risks that you are taking to make up an excess return by not investing into the government risk-free securities, but investing into the Nifty 50 as an index, into the equity Nifty 50 index. The difference between the two is the equity risk premium or the market risk premium. So here's the formula to calculate the cost of equity. Now, the thing is, cost of equity is a very critical input in the calculation of the WACC, the weighted average cost of capital, or simply the cost of capital, also called as the overall cost of capital. It is a very critical input to discount the future cash flows in the financial modeling and valuation exercise, right? So the risk-free rate is simply we can get from Google. We can go to Google and calculate ki what is, not even calculate, just copy paste ki what is the return upon a 10-year government bond. Usually, a 10-year government bond is taken for this scenario because the longer duration bond or a longer maturity bond, it tends to average out the fluctuations in the interest rate. The volatility of a longer duration government bond, it tends to come down usually, right? It is also the proxy for the country's growth. It's also the proxy for the country's long-term growth rate. Short-term yields or short-term securities yields might fluctuate a lot over a short-term period. Hence, a longer-term bond tends to avoid all these kind of fluctuations, a much more averaged out proxy, right, for the long-term growth of the country. Again, the bonds are also much more risky because I would say, a longer duration bond is much more susceptible to the interest rate risk. But broadly, a longer duration bond, it tends to reflect the average growth trajectory of the country also in the long-term period. So, for example, if I just simply go to Google, if I just simply go to Google and I'll just share my screen as well. And if I just type in here, India 10-year bond yield, it's giving me because I track it daily. I just go to like any of the websites, it shall give me the latest available number. The latest available number is 7%. So 7% I can take in here. Just copy paste, I can do the number, I can simply just type it. I go back to my Excel file. So once I go back to my Excel file, that 7% number can be taken up here. Now beta, how to calculate beta. So before calculating beta, let's go to the return upon market. That's the Nifty 50 return, not the past 1 year return, not the past 1 month return. Average 10-year return we can take to calculate the RM, right? Simply we can calculate a 10-year CAGR. A 10-year CAGR for Nifty 50 has been closer to some 11.5% to 12% odd. इतना ही आपको Nifty 50 देती है in the long term. So maybe that number I can take in here and I can simply subtract 7% out of it. So if I go to this tab, the RM tab, I've taken the details, right? The past 10-year data I've taken up, right? Again, some random data. Now this is the Nifty 50 ka data, right? The dates might seem old, but it's a 10-year data. Value as on end date is 14691. It's a 10-year data starting from 2011. Value as on start date is 5835. The market return is 9.67. So 9.67% becomes the compounded annualized CAGR. So here I have applied the formula for the compounded annual growth rate CAGR. That's your final value, the ending value, divided by the beginning value to the power of 1 by number of days minus 1. And यहाँ पे कितने number of days है मेरे पास? I've simply taken the time period. That is how many days are there for 10 years. Take a like simply for 10 years, right? So the ending value, the final value divided by the beginning value to the power of 1 by time period minus 1. CAGR मैंने simply यहाँ पे निकाल लिया. Or simply I can also, what I can do is, one more thing I can just do. There's a function in Excel that gives you the CAGR, the RRI function, right? So what I can do in here is the number of payments per year. Absolutely. I'm trying to calculate the CAGR for 10 years. The present value is 5834, the current value, and the future value is 14691. Again, it shall give me the same number. So again, I can simply use the RRI function as well in Excel to calculate the CAGR instead of using the whole full-fledged formula. Right? अब ना यहाँ पे I've calculated the return upon market. I can simply calculate beta also. So here are the numbers for some hypothetical company to make you understand. So these are the closing prices of that hypothetical company. I've simply calculated the percentage daily return, right? The final value minus the beginning value divided by the beginning value. That is simply the percentage change formula. I've done that for every day. I've done that for every day. Now, how to calculate beta? Ignore this unlevered and levered beta, target D by E, so that we can discuss later. So basically, I'll be calculating a levered beta. The beta that you use in a CAPM model is a levered beta. That is, it includes the impact of debt. The debt to equity ratio is a part of this levered beta. Now it's a function called as slope in Excel. You do is equal to slope, y variable and x variable. Correct? In the y variable, I've simply taken what? I've simply taken the return upon the stock, and my x variable is the return upon the market. So simply the kind of the daily return which I have calculated for the stock, I've also calculated the daily return for the equity index, the Nifty 50. So Nifty 50 is my dependent variable. The stock market returns are my the Nifty 50 is my independent variable, and the stock market returns become my dependent variable. अब वो मैं करता हूँ, तो यहाँ पे simply in my independent, right? So firstly, I use my dependent variable. That's my stock return. I select this whole column, right? So if I just simply do is equal to slope, I take my dependent variable, that is the returns, all the returns here. I do a comma, correct? Then I simply take the returns on my independent variable. I close the bracket and I get my beta. So that's my levered beta 0.60. Now it's a defensive beta. When beta is less than 1, it's a defensive beta. When beta is more than 1, it's an aggressive beta. So for example, if my beta had been 1.2, it simply means if the index rises by 1%, if the index rises by 1%, my stock will rise by 1 into 1.2 by 1.2%. If the index falls by 1%, my stock will fall by 1.2%. That is, my stock is reacting much more vis-a-vis the index. But in case of a beta less than 1, my stock is reacting less as compared to the index. So that's the definition for an aggressive beta or a defensive beta. Again, this beta can be used in here, right? So how can I calculate the cost of equity? If I simply go to WACC, I have the risk-free rate, right? I can change it to 7%, right? I have the market equity return, I have the equity risk premium. That's simply the difference between the market rate of return, the Nifty 50 ka return minus the risk-free rate. And here I have the beta which I have calculated 0.57 to round it off to 0.60. And here I simply use the formula, the risk-free rate plus beta into the equity risk premium. This difference I've taken up here directly. And now it is simply giving me the cost of equity. My cost of equity in this case is 8.5%. Higher the cost of equity, it means higher the risk you are taking for investing into the equity markets. Now this was a generalized example just to make you calculate the cost of equity. Thank you so much.